The current investment thesis for Rio Tinto is defined by attention, a robust bull case centered on the successful ramp-up of world-class copper and lithium assets, and a significant bear case driven by structural demand destruction in the Chinese property sector and the geopolitical instability of new supply frontiers. Operational performance and the transition to copper equivalence. The fiscal year 2025 served as a pivotal proof of concept for Rio Tinto's stronger, sharper, simpler strategy. The company achieved an 8% increase in copper equivalent (CuEq) production, a metric it increasingly uses to signal its transition away from pure iron ore dependency. This growth was not merely a result of favorable market conditions, but was underpinned by disciplined project execution at Oyu Tolgoi and a record year for bauxite production.
Production and financial metrics. The financial results for 2025 reflect a company that is harvesting cash from its legacy assets to fund a massive expansion into green metals. Underlying EBITDA rose 9% to $25.4 billion, while net cash generated from operating activities reached $16.8 billion. Despite these strong headline figures, profit after tax attributable to owners fell 14% to $10 billion, impacted by higher depreciation and the investment phase of several major projects. The stability of the dividend at 402 cents per share, representing a 60% payout ratio, marks the 10th consecutive year that Rio Tinto has returned cash at the top end of its target range. This consistency remains a primary draw for investors seeking yield in a volatile commodity environment. The bull case, future-facing diversification. The bullish argument for Rio Tinto rests on three primary pillars: the emergence of copper as a dominant earnings driver, the aggressive build-out of a top-tier lithium business, and the deployment of industry-leading automation to protect iron ore margins. Copper is no longer a secondary commodity for Rio Tinto, it is the cornerstone of its growth narrative. In 2025, annual copper production grew 11% to 883 kilotons, exceeding the top end of the company's guidance. This growth is primarily attributed to the underground ramp-up of the Oyu Tolgoi mine in Mongolia, which is on track to become the world's fourth largest copper mine by 2028. The fundamental bull case for copper is supported by a widening supply-demand gap. Global copper mine supply is expected to peak in 2030 and decline through 2035 due to deteriorating ore grades and a lack of new discoveries. Meanwhile, demand is projected to grow exponentially, driven by electric vehicle adoption, renewable energy infrastructure, and the massive cooling and power requirements of artificial intelligence data centers. The efficiency gains in the copper segment are particularly notable. Rio Tinto achieved a 53% reduction in C1 net unit costs to 67 cents per pound, largely due to the higher-grade ore being accessed in the Oyu Tolgoi underground phase. Furthermore, the company is innovating through its Nuton technology, a proprietary bio-leaching process that allows for the extraction of copper from low-grade primary sulfides, potentially unlocking value from vast waste stockpiles across its global portfolio. The lithium strategy. In early 2025, Rio Tinto completed the $6.7 billion acquisition of Arcadium Lithium, a move that established the company as one of the largest lithium producers globally. This acquisition was strategically timed to capture assets at a cyclical low, as lithium prices had fallen over 80% from their 2022 peaks. The Arcadium deal integrates brine assets in Argentina and hard rock assets in Canada with Rio Tinto's existing Rincon project. The company is now targeting a production capacity of 200,000 tons of lithium carbonate equivalent by 2028, with a long-term vision of reaching 460,000 tons by 2033. The bull case for lithium is predicated on the rapid expansion of battery energy storage systems, which are expected to reach 1.5 terawatt-hours of capacity by 2030. Rio Tinto's focus on direct lithium extraction at the Rincon project is a key technological differentiator, as it promises higher recovery rates and a lower environmental footprint compared to traditional evaporation ponds. Automation and the iron ore margin shield. While iron ore faces structural headwinds, Rio Tinto's Pilbara operations remain a cash generator due to their scale and technological integration. The Gudai-Darri mine, Rio Tinto's most advanced automated facility, reached its full 51 megaton per year run rate in 2025, helping the company maintain some of the highest margins in the industry. The deployment of autonomous haulage systems and automated drilling has allowed Rio Tinto to decouple production costs from labor inflation,
Despite inflationary pressures in Western Australia, the company is on a pathway to deliver a 4% compound annual growth rate improvement in unit costs through 2030. This cost leadership provides a margin shield, ensuring that the Pilbara remains profitable even if iron ore prices fall to the $75 to $80 per ton range.
The bear case, structural decline and geopolitical risk. The bearish perspective on Rio Tinto is rooted in the inescapable reality that iron ore still accounts for 60 to 65% of the company's revenue. The bear case argues that the transition to green metals, while strategically sound, is moving too slowly to offset the structural collapse of Rio Tinto's largest market, the Chinese property sector. The China conundrum, property collapse and steel demand destruction. The relationship between China's property sector and global iron ore demand is broken. Historically, Chinese construction consumed 40% of the nation's steel, but in 2025, property investment collapsed by 17.2%. This is not a cyclical dip, but a policy-driven demand destruction, as Beijing shifts its economic focus from residential infrastructure to high-tech manufacturing and the energy transition. Chinese crude steel output has fallen below 1 billion tons for the first time since 2019, and demand is forecasted to drop further to 837 million metric tons by 2026. For Rio Tinto, which derives approximately 70% of its revenue from China, this structural shift represents an existential risk to its core business model.
Furthermore, the rise of the China Mineral Resources Group has shifted the power balance in the iron ore market. By June 2025, CMRG had become the single biggest force in the $130 billion iron ore import market, using its centralized buying power to challenge the pricing mechanisms traditionally dominated by Rio Tinto, BHP, and Val. The Simandou supply glut and price erosion. The Simandou project in Guinea, while a technical marvel, poses a significant threat to global iron ore pricing. As Rio Tinto and its partners ramp up production toward 120 million tons per year, the market is bracing for a supply glut of high-grade ore. Internal forecasts from major miners suggest that as Simandou reaches full capacity over the next 2.5 years, the price of iron ore could fall to $85 per ton. While Rio Tinto's Pilbara operations have a low cash cost, a sustained price environment below $80 per ton would significantly compress margins and potentially threaten the company's ability to maintain its 60% dividend payout ratio.
Geopolitical instability and trade volatility. Rio Tinto's operations are increasingly exposed to geopolitical risks that are difficult to mitigate. The Simandou project, for instance, requires a 600-kilometer rail corridor through ecologically and politically sensitive terrain. A fatality in February 2026 led to a temporary suspension of mining operations, highlighting the fragility of project timelines in Guinea. On the global stage, the resurgence of trade tariffs under the incoming Trump administration in the United States has introduced new volatility. Tariffs on steel and potential duties on Chinese-manufactured green technologies could disrupt the global supply chain for Rio Tinto's products. The subsidy wars between the US, EU, and China regarding EV manufacturing create a highly unpredictable demand environment for copper and lithium, making long-term capital allocation decisions more hazardous.
Strained indigenous relations. While Rio Tinto has signed a landmark co-management agreement with the PKKP people, other conflicts remain. At the 2025 Annual General Meeting, representatives from the Robe River Kuruma Aboriginal Corporation alleged that the company had cheated them out of 17 years of payments and used misleading information to avoid fair compensation for the Mesa J mine. These ongoing disputes are not just reputational, they have direct operational consequences. Operations in the Pilbara remain subject to the heritage clearances, and a failure to secure community consent can delay critical mine extensions like Brockman Syncline 1. Environmental costs. The company's decarbonization pathway has been revised, with the capital estimate for 2030 emissions reduction falling from $5 to $6 billion to $1 to $2 billion, as Rio Tinto shifts toward leveraging third-party renewable investment. Also, cyclones in Australia and wildfires in Canada continue to disrupt production and drive up insurance and maintenance costs.
Pure comparison and valuation analysis. In the competitive landscape of the Big Four miners, Rio Tinto occupies a middle ground between the stability of BHP and the high-growth, high-risk profile of Fortescue. Rio Tinto versus BHP Group. BHP is generally viewed by analysts as a more execution-focused business with a lower-cost asset position across its entire portfolio.
While Rio Tinto has more aggressive growth targets in copper and lithium, BHP's diversification into potash via the Jansen project provides a unique hedge against agricultural cycles that Rio Tinto lacks. Rio Tinto versus Vale SA. Vale has recently surpassed Rio Tinto's Pilbara production, regaining its title as a leading iron ore producer. Vale is currently seen as more attractively valued than Rio Tinto, trading at a lower forward price-to-sales multiple, 1.65x versus 1.87x, while offering a higher dividend yield. However, Vale carries higher idiosyncratic risks related to its tailings dam legacy in Brazil. Rio Tinto versus Fortescue. Fortescue remains the most sensitive to iron ore price swings and faces significant execution risks with its green energy diversification. Rio Tinto is seen as a more balanced alternative, offering exposure to the energy transition through established world-class mining assets rather than early-stage hydrogen ventures.
The dividend formula and capital allocation. Rio Tinto's capital allocation framework is tested by its simultaneous commitment to high dividends and high capex. In 2025, the company invested $12.3 billion in property, plant, and equipment, a 28% increase from 2024. With midterm capex expected to remain between $10 billion and $11 billion through 2027, the company is relying on sustained iron ore prices above $90 per ton to fund both its growth and its payout, without significantly increasing its net gearing. The sustainability of the current dividend yield, $4.02 per share, is highly sensitive to the iron ore price. Based on current production of 327 million tons, a $10 per ton drop in the realized price of iron ore would result in a multi-billion-dollar hit to underlying EBITDA, potentially forcing a reduction in the payout ratio toward the lower end of the 40-60% range.
Synthesis. Rio Tinto is currently in what industry analysts call the valley of death for diversified miners, the period where legacy cash cows are maturing and declining, but new growth pillars have not yet reached full scale to replace the lost earnings. For the bull case to fully materialize, several key unlocks must occur over the next 24 to 36 months. 1. Oyu Tolgoi full ramp. The transition to 500 KTPA copper production must occur without further technical or political setbacks in Mongolia. 2. Lithium market rebound. LCE prices must stabilize and recover toward the $20,000 per ton level to validate the 15 to 18% IRR projected for the Arcadium and Rincon investments. 3. Simandou execution. The Guinean infrastructure must be completed on schedule to allow Rio Tinto to benefit from the grade premium of 65% Fe ore as the global steel industry shifts toward lower-emission electric arc furnaces. Conversely, the bear case gains momentum if the following tipping points are reached. 1. China hard landing. If the property collapse leads to broader systemic financial instability in China, steel demand could fall significantly faster than the current 2 to 3% annual decline forecast. 2. Supply surge impact. If Simandou and Vale's ramp-up occur into a contracting market, iron ore prices could stay below $80 per ton for an extended period, leading to dividend cuts and a downgrade of Rio Tinto's credit rating. 3. A significant new heritage incident or a failure to resolve the Robe River-Karuma dispute could lead to institutional divestment and a permanent compression of Rio Tinto's valuation multiples.
Conclusion. Rio Tinto Group enters the second half of the decade as a company of two halves. Its old-world iron ore business is a titan under siege, facing structural demand destruction in its primary market and the threat of self-inflicted supply gluts. Its New World copper and lithium business is a high-growth, technically advanced powerhouse that is perfectly positioned for the electrification trend. For the investor, the decision to hold RIO stock depends on a fundamental view of timing. The bull case requires a belief that the green metal sales can catch the wind of the energy transition before the iron ore anchor drags the company's earnings into the depths of a Chinese property-led recession. At current valuations, the market appears to be pricing a balanced outcome, but the high volatility of commodity cycles suggests that the road to 2030 will be anything but stable. Rio Tinto remains a high-quality operator with a strong balance sheet, but its fate is now tied as much to the laboratories of EV battery makers as it is to the blast furnaces of Chinese steel mills.